Hi, Katherine.
Hi, Anushka.
Thank you for joining
And
us for
you?
our Climate Responsibility in Banking series. What data sources do you recommend when analysing banks and their climate impact?
Some of the data sources that we use at Bank.Green to rate banks, some of them are pretty big, complex documents that require you to understand like disclosure frameworks and standards. So I wouldn't recommend them for novices, but let's just start and tell you about what data sources we use, and then we can go into what I would recommend. So we use four main data sources. The main ones are financial statements. These are documents that every bank, certainly every public bank, will publish. That one goes to investors. It's filed with the stock exchange if the bank is listed. And so banks, and just like other companies, they invest a lot of time in making sure that all the disclosures are correct. Because if the disclosures are incorrect, that's really dangerous, because that potentially is you misleading your investors, you're misleading your customers, and there could be some serious penalties attached to it. We know that data can be trusted. So we always look for that table. Sometimes it doesn't exist. Not all banks transparently disclose that sort of information. And so consequently, they lose points according to our lending methodology. But so we're always looking for a breakdown, or at least a description of sectors that they invest in, or in this case, lend to. So it could be quantitative data, it could be qualitative data, but that's the main source of data that we use. Then the second biggest is sustainability report, also known as ESG report or CSR report or climate report. Essentially, it's a sustainability report. We, first of all, cross-check data in the annual report, the sustainability report, and we look for inconsistencies. But sustainability reports, they're a really good source of data on renewable energy lending. We want to pick it up and make sure that we're just separating data on renewable energy lending, energy efficiency lending, that sort of thing. And then we look at two more major data sources. One is the toxic bonds database. So one way that banks continue investing in fossil fuels or continue supporting the fossil fuel industry is not just by lending, but also investing in bonds in energy companies that finance new coal infrastructure or other fossil fuel projects. And so we look at that database, and it shows all these energy companies and which bonds they issued, and then which banks hold bonds in them. And then finally, we look at banks' own websites for green products. For example, do they afford their customers preferential interest rates on loans to buy electric vehicles or energy efficiency improvements in homes? Now, there are other data sources and bits of information that would take into account. So, for example, if a bank has gone through a very rigorous B Corporation certification and they're certified as a B Corp, we'll look at that as well, because that essentially confirms that a third party has looked at the way this bank operates and has confirmed, a given sort of independent seal of approval, that this financial institution is not just driven by profit motive, but also cares about the environment and its people. As I said, financial statements can be really difficult to read and interpret, but please do go ahead and take a look at them. Sustainability reports are easier to read when they are developed and they're published. They typically publish with a much broader stakeholder base in mind than just investors. So they're written in a more user-friendly manner, and they include a lot of pictures as well. So they're easier to digest. And then obviously the bank's website is a useful source of information. Many publications, like The Guardian, is known for spotlighting banks' greenwashing. So obviously there's the media coverage of banks that's also worth looking at. So those are the main ones that, yeah, I would highlight for the purposes of this discussion.
Great, thank you. And so it seems like there are a lot of climate-based reports, like the
Mhm.
CSRD and toxic bond report. And I feel like you've already addressed this a little bit, but what do these reports actually tell us?
So financial statements, backward looking, right? So they tell us about the present state of affairs or even the historical state of affairs. They're drafted to a particular date, we call it the balance sheet date. So right now in March 2025, most banks have just published their 2024 financial statements, and that shows us the state of affairs as at, say, December 31st, 2024. So they're really helpful for understanding history. They are also helpful in helping us understand if a particular bank is reducing or increasing its exposure to the fossil fuel sector year on year. And it also shows, helpfully, whether commercial lending, so lending to commercial customers, is a small or a large percentage of the overall lending. So as I said, there are some banks that actually don't lend to any commercial clients. They only do business with individuals, which is a very helpful data point in itself, because that means they're not financing the fossil fuel industry, at least not directly. And it also gives us absolute numbers. So say if a small regional bank has 50 million pounds or dollars of outstanding lending to commercial organizations, they won't be financing a pipeline, right? Maybe a local petrol station or gas station if you're in the US, but it's not going to be a pipeline, right? So again, those data points are really helpful, and we take all of this into account in our rating process. What sustainability reports tell us, they're much more forward-looking. They're telling us about banks' aspirations and their targets and their desired decarbonization pathway. So the way that they will actually green up their portfolio. So they're much more forward-looking, aspirational, not as rigorous in terms of numbers. Although I think sustainability reports are trending that way. And ultimately, the goal of the regulators and the trend that we're seeing is that both of these reports are now integrated. So very often you see one integrated report that brings together financial statements and also sustainability disclosures. So yeah, so the focus is different, the audience is different, and they really complement each other. And as I said, from our perspective, what we really look for is, does the bank actually tell a coherent story? Like, what they're telling us about the future state, does it align with what's actually happening now, or at least at the last balance sheet date?
Great, thank you. And on that note, what should we look for in a bank sustainability report or on its website?
Good question. So I'd say look for details, right? You can very easily and quickly tell a bank that is serious about, as I said, greening up their portfolio, about meeting the goals of the Paris Agreement, and the ones that are just using their sustainability report as a marketing exercise for greenwashing purposes. The good ones have a lot of detail, right? They will have greenhouse gas measurements. So that means they understand their baseline. There's a famous saying that you cannot manage what you can't measure, right? Or what is not measured cannot be managed. So if the bank has measured its impact on the planet, then we can actually believe that their plan, if they have one, as opposed to a bank that is already telling us about their goals, but it hasn't actually measured its baseline. So look for details. If the only thing that a bank is doing is saying that they've set a net zero 2050 target, that's not good enough, right? We need a plan. We need a plan for 2025 to 2030. We need milestones. We need it for each sector, because each sector has a very different carbon intensity profile. And then what we also don't want banks to be over-indexing on, over-focusing on too much, is like small detail, right? I think we talked about it that week when we covered greenwashing. Paperless statements, that's a red herring. It's neither here nor there. It's not important. It's a tiny aspect of a bank's impact on the environment. We really look for evidence that they understand, they have a grip on their impact on the environment, particularly from perspective of energy sector financing. And we want a very robust plan to increase lending to renewables, decrease the exposure to fossil fuels. So as we're looking at for as much detail as possible, and it being backed up by credible measurement and data.
Great, thank you. And so my last question, reports sound like they're quite long, quite lengthy, a lot to sift through. What's the most and least important thing to hone in on when we're addressing these reports?
Yeah, so once again, I've said this before, but I'll repeat because I think it's a very important point. Look at the actuals, look at the data. Do not just look at aspiration. Anyone can set a target, particularly 2050 target, when, you know, that individual, a group of individuals that have signed up on this target will no longer be with an organization that probably would have moved on or retired by that stage. So we look for actuals, statements of what's actually happened in the past, as opposed to something that may or may not happen under a certain set of conditions in the future. Second thing is look for formal policies, not just a statement that says, oh, we undertake to do X, but look, we have a policy, and you can see this is a 5-page policy that was approved by a board that says that we will not lend to an energy company that derives more than 5% of its revenue from fossil fuels. As an example, again, we're looking for that specificity. So we're looking for evidence that the board of the company and senior executives understand the climate risks that are involved, not just for the world, but for the company itself, from its continued support of the fossil fuel industry. We would look at that high level buy-in and understanding. And then we look at evidence of governance around that, all the different committees and different reporting processes and data collection, and then how that all percolates towards like having a robust transition plan. So transition plan is maybe not a term that many people are familiar with, but it's becoming really important now that most banks have, to some extent, maybe not fully, but most large ones anyway, have measured some of their carbon footprint and have set certain targets. And of course, there's still a long way to go. But really, at this point, we need to be putting in place transition plans, really detailed plans to move away from fossil fuels and towards a cleaner future. And if a bank has a transition plan in place, that is really good evidence that they are well and truly on the way there where we need them to be in terms of their environmental impact. So yeah, actuals, not aspirations, formal policies rather than just wishy-washy statements, governance around it, and specificity, numbers, facts, and data.
Great. Thank you so much, Katherine. That's everything from me. And that's the end of our 8th episode in this series where we analyze useful data sources. So hopefully now our viewers have some takeaways on which sources to go to and what to look for in those sources. Cool. See you next time. Thank you so much.
Good to
Bye.
see you. Take care. Bye.
Bye.